You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today, we're taking a really close look at a recent global market and geopolitical briefing that you've shared with us. Our mission, like always, is to pull out the most critical insights, give you that sharp edge in understanding this, pretty complex world we're in.
Yeah, it certainly is complex.
Yeah, we'll be navigating through some, let's say, high-stakes territory today, thinking about foreign exchange dynamics, commodities, trade strategies, geopolitics.
The whole picture.
Exactly. And even how these big global currents show up in, specific domestic policies. It's about getting that comprehensive view, trying to find some clarity in all the noise.
And that clarity, that's precisely the aim. Because these briefings, they aren't just lists of facts, are they? They're narratives, cause and effect playing out globally.
Right.
So in this deep dive, we really want to connect those dots for you. Show how something happening in Beijing or a debate in Brussels, how they actually link up.
Yeah, how they weave together.
Exactly. Influencing markets, influencing policies maybe thousands of miles away. It's about getting that holistic understanding, without drowning in the data.
Absolutely. It's those connections, often hidden, that really tell the story. So for you listening, let's start digging in. What forces are really driving things right now? Global markets, the political scene. Let's start where so much begins. Foreign exchange.
Yeah.
Currencies. What's the latest on the U.S. dollar? What are traders really watching?
Well, the dollar, it's been kind of stuck in a holding pattern, largely unchanged after a pretty flat day before. It's basically waiting, poised for some big signals from the U.S. economy.
Okay, what signals specifically?
Traders are really zeroed in on three main things coming up. Today, you've got U.S. GDP figures. That's the big picture health check, right? And jobless claims data, too, tells us about the labor market. But the real heavyweight, the one everyone's waiting for, is tomorrow's PCE release. Personal consumption expenditures.
The Fed's favorite inflation number.
Precisely. That's the Fed's preferred inflation gauge. So those numbers, they'll be absolutely critical for shaping what people expect on future monetary policy. And that directly drives where the dollar goes next.
Okay, so given how sensitive everyone is to inflation, to PCE data, is there a risk that maybe even a slightly off number could trigger an overreaction in the dollar?
Wow.
Or are markets smarter than that now? And how does that potential volatility hit the euro and sterling? They seem to be fighting their own battles.
That's a really good point. Markets are generally sophisticated, but honestly, any real deviation from expectations on PCE, it could absolutely spark an outsized reaction, especially with all the uncertainty around potential rate hikes right now.
Right.
Now, for the euro, it's actually managed to edge a bit higher. It bounced back from below that 1.16 level. But, and this is the insightful part, despite that little recovery, it's really being weighed down. Two big things. One is the persistent political uncertainty in France. That always adds a bit of a risk premium, And the other is a string of kind of soft sentiment surveys coming out of the Eurozone.
Leading indicators.
Often, yeah. They suggest a pretty sluggish economic outlook, and that just dampens any real sustained enthusiasm for the euro, whatever the dollar's doing.
So even with a little bounce, the euro's still got these underlying weak spots. What about sterling? Is it doing any better, more stable, or facing similar issues?
Sterling has clawed back some ground. It's moved back above the 1.35 mark. However, its momentum, much like the euro's actually, seems capped.
Capped.
Yeah, the briefing points to a definite lack of fresh catalysts. Nothing really new to push it much further. So while it's recovered some losses, the market just isn't seeing compelling reasons, data, politics to drive it significantly higher or lower right now. It's kind of consolidating, maybe waiting for its own UK-specific triggers to pop up.
Right. Makes sense. Okay, moving beyond the big guys, the majors, we often see different things driving the yen and also those Pacific currencies, the Aussie and the Kiwi. What's the picture there, especially thinking about Japan's, long-standing monetary policy situation?
You're right, different dynamics entirely. The yen, it's been trading pretty indecisively. We did see a comment from Bank of Japan board member Nakagawa. He basically reiterated the bank's willingness to raise rates if the economic outlook permits.
Which is a shift, verbally at least, after all these years.
A huge shift. For BoJ watchers, that's significant after decades of ultra-loose policy. But interestingly, the market reaction was minimal, barely a ripple.
What does that tell us?
It suggests that while, yeah, a rate hike is maybe on the table now, traders just aren't convinced it's happening anytime soon. They probably see that economic outlook condition as a big out for the BoJ, a way to delay.
So wait-and-see mode continues for the yen.
Pretty much. Prolonged wait and see, despite the words changing slightly.
Okay, so the market's kind of discounting any immediate policy change there. That's telling. Now, what about the Australian and New Zealand dollars, the commodity currencies? How do they fit in, especially with China's influence in the region?
Yes. And this is where you really see China subtly but powerfully flexing its economic muscles. Both the Aussie and the Kiwi dollars, they managed some modest gains against the US dollar.
Right.
And that strength, you can pretty much trace it directly back to actions by the People's Bank of China, the PBoC.
Like what?
Specifically, China kept strengthening the yuan's reference rate, basically guiding its own currency higher day by day. And importantly, they also extended their currency swap line with New Zealand.
Right, the swap line.
Yeah. And what's really insightful here is how China uses these seemingly technical tweaks, the reference rate, the swap line extension, not just to support its trading partners, but also to subtly reinforce its own geopolitical and economic clout in the Pacific.
Soft power through currency.
Exactly. It creates this financial ripple effect that often gets missed in the big market headlines. It's a very precise way to support key commodity suppliers like Australia and New Zealand.
That is a sharp point about the deeper strategy there. And it's actually a perfect lead-in to our next topic, commodities. Given all the supply chain stuff, geopolitical tensions, what's been happening in the, well, often wild world of crude oil?
Wild is right. Crude oil actually eased back a bit overnight, gave up some of the gains it made yesterday.
And what drove those earlier gains?
Two main things, really. First, there was anticipation building about potential additional sanctions on Iran. That usually tightens supply expectations. And second, we saw a larger than expected drawdown in U.S. crude stockpiles. That suggests demand is holding up pretty well in the U.S.
But then it eased back.
Yeah, which makes you wonder, doesn't it? Is this just a temporary breather? Or maybe it signals some underlying skepticism among traders about whether those price drivers are sustainable. It's always this constant recalibration, supply versus demand, and expectations can shift really fast.
So even strong signals get second-guessed.
Oh.
Okay. What about precious metals, gold, and industrial metals like copper? Similar story of pausing, or are they telling us something different about economic sentiment?
They are showing a kind of market indecision, too, or consolidation, but maybe for slightly different reasons. Spot gold, for instance, softened a bit after it stalled near that $3,400 per ounce mark.
Hitting resistance.
Exactly. It suggests $3,400 is a pretty significant psychological and technical level. The market seems to need a fresh, strong reason to push decisively above that. And copper, we saw it trading sideways.
Sideways, meaning what?
Well, the briefing directly attributes it to constrained demand, especially after some recent price declines. Copper, is often called Dr. Copper because it's seen as a bellwether for the economy, used everywhere, construction, industry.
Right. So if copper's demand is constrained, that sounds worrying.
It could be. If copper's sideways trade is signaling weak demand, it does make you question some of the more optimistic sentiment data we sometimes see. It suggests maybe industrial activity, particularly in big consumer nations, might be slowing down or at least not picking up as fast as hoped.
That's a crucial point about potentially conflicting signals there. Okay, looking specifically at China again, a huge player in metals. What are they planning for their steel industry? That must have massive global implications.
Oh, absolutely. China's steel plans are hugely significant. It reflects their domestic needs, sure, but also global resource management, big ripples worldwide. The briefing outlines China's plan to stabilize its steel industry, looking out towards 2026.
Stabilize how? Just cutting output.
It's more strategic than just output cuts. The plan includes a pledge to accelerate key domestic iron ore projects.
Reducing import reliance.
Exactly. China is the world's biggest iron ore importer, so boosting domestic production is key for their resource security. Less reliance on, say, Australia or Brazil, plus they plan to strengthen oversight of steel exports.
Meaning, like quotas or price controls.
Could be regulating pricing, quality, maybe even volume. it definitely impacts global supply chains. And it could also be a way to address accusations of dumping cheap steel onto world markets, which has been a sore point in trade talks for years.
Right.
If you connect the dots, it really speaks to China's long-term economic planning. Greater self-sufficiency in critical materials, that's going to reshape global trade flows for years.
Yeah. That really highlights how national industrial policy becomes a powerful global lever. Okay, let's pivot now to trade and tariffs. Because these aren't just economic tools anymore, are they? They're frequently used as instruments of, well, global economic leverage. What are the big headlines there? Especially where trade meets geopolitics.
Yeah, you see that very clearly on the trade front. The White House, for instance, has signaled that India could get a pretty hefty 25% reduction in tariffs.
Oh, that's significant.
It is. But there's a big if. If India halts its imports of Russian oil.
There's the geopolitical string.
Exactly. It's a direct attempt to use economic carrots, or maybe sticks, to influence India's energy policy. And by extension, to further isolate Russia. It forces India into a tough spot, weighing economic benefits against existing political and energy ties.
Definitely.
Separately, India also made its own move, extending its exemption on cotton import duties through the end of the year, probably to help its domestic textile sector or manage raw material costs.
That's a stark example, the India-Russia oil one, of trade and foreign policy being completely tangled.
Right.
What about actions from Japan and Mexico? Are they also adjusting their trade stances, maybe aligning regionally?
Yes, very much seems that way. Japan's top trade negotiator had to postpone a trip to the U.S., but they're aiming to reschedule for next week. That just signals, ongoing high-level talks, probably complex bilateral issues needing careful handling.
Okay. And Mexico?
Mexico's laid out more concrete plans. As part of their 2026 budget proposal, they intend to raise tariffs on a whole range of Chinese imports. Cars, textiles, plastics.
That's a big move against China.
What? Could be a couple of things. Protecting their own domestic industries from Chinese competition is likely part of it, but it might also be a strategic alignment with North American partners, especially the U.S., which has also been raising barriers to Chinese goods. It shows countries actively recalibrating trade policies for their own interests.
So even long-standing partners are rethinking things.
Yeah.
And how are Canada and China managing their relationship? It's often complex, sometimes pretty strained. What does constructive engagement actually mean on the ground?
Well, the talks between Canada and China apparently stress the need for that constructive engagement, both sides agreeing to manage differences pragmatically.
Diplomatic language.
Very diplomatic language. It suggests they both acknowledge the tensions, the disagreements are there, but they also want to keep talking, avoid things escalating. What it means in practice for Canada. It's often this really delicate balancing act, trying to get economic benefits while still upholding, Western democratic values on things like human rights or intellectual property.
A tightrope walk.
Definitely. It highlights that challenge many Western nations face. How do you balance economic interests with geopolitical concerns when dealing with China? Pragmatic management often means quiet diplomacy on the really thorny issues.
That's a really insightful point about reading between the lines of diplomacy. Okay, so if we take all these trade moves, these economic pressures, what does it all mean for the bigger geopolitical picture? Are we seeing direct flare-ups or shifts?
We're certainly seeing continued regional hotspots and international responses. In the Middle East, for example, Israel carried out a series of strikes on military facilities southwest of Damascus in Syria.
Okay.
And at the same time, Syrian sources reported a 2-hour special forces operation in that same area. These events just underscore how volatile that region remains. Active conflict, various players making moves.
In constant risk of escalation.
Exactly.
Right.
It's critical to see these not as isolated incidents, but as part of this ongoing, deeply entrenched conflict where any action could potentially trigger something bigger.
A crucial reminder of that volatility. And shifting to Europe, what are the latest developments regarding Russia's war effort? Is international pressure still building? What are the complexities there?
Indeed. In Europe, the EU is currently weighing the possibility of implementing secondary sanctions.
Secondary sanctions, meaning targeting third parties.
Precisely. Not targeting Russia directly, but hitting entities or individuals outside Russia who are seen as helping its war effort or helping it get around existing sanctions. EU foreign ministers are actually due to meet in Copenhagen later this week to discuss the options.
That sounds like a potentially powerful but also complicated step.
Extremely complicated. It raises a big question. Can the EU actually achieve the consensus needed for something like this? Secondary sanctions can be controversial. They can really impact third countries, global supply chains. It's a significant escalation in trying to choke off Russia's resources, but it also highlights the political and economic hurdles within the EU to agree on such impactful measures.
That's a really strong point about the challenges of consensus and the ripple effects. Okay, let's bring this closer to home now. How do these huge global forces actually translate into tangible domestic policy? What's brewing, for instance, in the UK on the fiscal front?
Yeah, this is a perfect illustration of that connection. The UK Treasury is reportedly looking at a potential tax hike specifically aimed at landlords
How so?
by potentially imposing national insurance contributions on rental income. Currently, rental income isn't subject to NI in the same way that, say, employment income is. This is apparently being considered ahead of Chancellor Reeves' autumn budget.
And the impact?
Well, if it happens, it could significantly squeeze landlords' profits. That might, in turn, influence rental prices for tenants or maybe discourage investment in rental properties altogether. It's a very direct link between national fiscal policy, maybe driven by a need for more government revenue, or perhaps an attempt to address wealth distribution and the broader economic pressures.
And you have to wonder about unintended consequences too, right?
Absolutely. Could it actually make housing supply issues worse down the line if it discourages investment in the rental market? That's the kind of second-order effect policymakers have to grapple with.
That's an essential point. Wow, this briefing really did cover a huge amount of ground, didn't it? From those subtle currency shifts driven by data and central bank talk, to the big strategic chess game of trade and tariffs, the harsh realities of geopolitical strikes, all the way down to potential tax hikes on landlords in one specific country, the UK. It just hammers home how interconnected everything is.
It really does.
A ripple in one market, a decision in one capital. The effects can stretch across continents right into our daily lives.
Absolutely. And what's truly fascinating, I think, is seeing those connections. How a currency swap line agreed on one side of the planet, or a tariff offer tied to oil imports, can ultimately echo in something like a debate about national insurance on rental income.
It's all part of that global tapestry.
Exactly. It's all interwoven. Economic incentives, political leverage, domestic needs are constantly interacting. And understanding those connections, seeing the why behind events rather than just the what, gives you such a richer, more useful perspective.
Precisely. And that, for you listening, really is the essence of this deep dive. Seeing those invisible threads, recognizing the levers of power. So, reflecting on all this, what stands out to you? How do you see these global threads weaving together? How might, say, a subtle shift in the yuan's reference rate that we talked about, or the final outcome of that EU secondary sanctions debate, how might that shape a story that breaks next month? Keep an eye out. Because once you start looking for these connections, you realize the deep dive never really ends. Keep observing, keep questioning, keep connecting those dots for yourself. Until next time, stay curious.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.